What if you could unlock a world where your money works for you? Where you could build wealth by understanding a few simple principles. Imagine being able to confidently navigate the stock market, even if you've never invested before. Today, we're diving into a beginner's guide to the stock market by Matthew R. Kratter, a no-nonsense roadmap that shows you exactly how to start making money in the market. Whether you're new to investing or just looking for clear, actionable advice, this video is your ticket to financial empowerment. So, grab your notebook and get ready to change your financial future. Let's begin with the basics. What is the stock market? Simply put, it's a marketplace where investors buy and sell shares of publicly traded companies. But there's so much more to it than just numbers on a screen. The stock market is a powerful tool for building wealth, and understanding its mechanics can open doors to financial freedom. Imagine a young professional who starts investing with just a few dollars. Over time, those small investments grow, compounding to create a significant nest egg. That's the magic of the market. Small, consistent steps can lead to big results. Stocks and shares, what they represent. Market indices, how indices like the S&P 500 track performance. Risk and reward, the relationship between risk, volatility, and potential returns. Compound interest, the power of reinvesting earnings over time. If you're new to the market, start by researching basic investment terms and reading up on how the market works. Consider watching beginner-friendly tutorials on the fundamentals of investing. Now that you know what the stock market is, let's explore why it matters and how it can work for you. You might wonder, why invest in the stock market instead of simply saving money in a bank account? The answer lies in the concept of growth. Banks offer interest, but the stock market offers the potential for exponential growth through capital gains and dividends. Consider two individuals with the same amount of money. One keeps it in a savings account, earning minimal interest. The other invests in a diversified portfolio. Over time, thanks to compound growth, the investor's money grows exponentially, building wealth far faster than a simple savings account could. Inflation, how it erodes the value of money saved. Capital gains, profits earned when selling stocks for more than you paid. Dividends, regular payments some companies provide to shareholders. Diversification, reducing risk by spreading investments across different assets. Reflect on your financial goals. Write down why you want to invest. Is it for retirement, buying a home, or achieving financial freedom? Understanding your why is the first step toward building a successful investment strategy. With your investment motivation clear, let's dive into the strategies that can help you succeed. One of the most important decisions you will make as an investor is choosing between long-term investing and short-term trading. For beginners, long-term investing is usually the best way to build wealth. It's less stressful and lets you benefit from the power of compounding over time. Imagine investing in a solid company like Apple or Microsoft and holding onto your shares for years, even decades. Over time, despite market fluctuations, the overall trend is upward. In contrast, trading requires constant attention, rapid decisions, and comes with higher risks. Many beginners find that long-term investing is both simpler and more rewarding. Start by opening a brokerage account and investing in a low-cost index fund. This lets you own a small piece of the overall market without the stress of day trading. Diversification is the cornerstone of a strong investment strategy. By spreading your money across different assets, you reduce your risk and increase your potential for steady growth. Consider a basket of eggs. If you put all your eggs in one basket and it drops, you lose everything. But if you have multiple baskets, one drop won't break all your eggs. Similarly, diversifying your portfolio means that a downturn in one sector won't devastate your overall investment. Research diversified investment options such as index funds, ETFs, or a mix of stocks and bonds. Develop a plan that aligns with your risk tolerance and financial goals. With strategies in place, let's talk about how to start practically, taking those first steps into the market. Now that you understand the basics and the strategies, it's time to put theory into practice. This section is all about actionable steps that you can take today to begin your investment journey. 1. Research and education. Start by learning the fundamentals. Read books, watch online tutorials, and follow reputable financial news sources. 2. Set clear goals. Define what you're investing for. Is it retirement, a major purchase, or financial independence? 3. Choose the right brokerage. Look for platforms that offer low fees, good customer support, and educational resources. Many brokers offer demo accounts to practice trading without risking real money. 4. Create a diversified portfolio. Begin with low-cost index funds or ETFs that track the overall market. As you grow more comfortable, you can explore individual stocks. 5. Monitor and adjust. Investing isn't a set-and-forget strategy. Regularly review your portfolio and adjust based on your financial goals and market conditions. Take the story of a young professional who started with just $500. By consistently investing, staying diversified, and reinvesting dividends, they built a portfolio that steadily grew over the years, even during market downturns. If you haven't already, open a brokerage account today and make your first investment, no matter how small. Every dollar counts. With the practical steps in place, let's explore the mindset needed to succeed in the stock market. Investing is as much about psychology as it is about numbers. A successful investor needs discipline, patience, and the ability to remain calm during market turbulence. Consider the investor who panicked during a market crash and sold everything at a loss. Contrast that with an investor who stayed the course, knowing that markets fluctuate and long-term growth is the goal. The latter often reaps the rewards of recovery and growth. Patience. Recognize that wealth is built over time. Discipline. Stick to your investment strategy, even when emotions run high. Emotional resilience. Learn to manage fear and greed. 2 of the biggest obstacles in investing. Start a journal where you document your investment decisions, emotions, and outcomes. Over time, this practice will help you identify patterns and become a more disciplined investor. Let's wrap up with a final recap and some motivational thoughts to kickstart your journey. Today, we've covered everything from the basics of the stock market to actionable steps that you can take right now. Remember, the key to success in the stock market isn't about getting rich overnight. It's about consistent, informed, and disciplined investing. Understand the fundamentals and why the stock market matters. Choose a long-term, diversified strategy over short-term trading. Take practical steps. Educate yourself, set goals, choose a brokerage, and start small. Develop the right mindset by being patient, disciplined, and emotionally resilient. If you found this video helpful, please hit the like button, subscribe for more beginner-friendly financial insights, and share your thoughts in the comments. What's stopping you from taking your first step into the stock market? Let me know below. And if you're ready to start your journey, check out the affiliate link in the description to open your brokerage account today. Remember, every great investor started with just $1.